if you don't mind.
No, no.
Thanks. Do you know what time it is? Is it time?
Okay. Wait till it's done.
Oh, it's 10. I'm back. Okay. Hi, everyone. My name is Natalie. I am co-president of the Emerging Markets Association. This week, we are launching the Real Deal Lunch Series, which will teach the Stern community a little more about emerging market countries that you might not otherwise know that much about. This week, we are partnering with ABS, the Asian Business Society, to bring you a session on China to learn about culture, food, currency, and things you might not otherwise know. It'll be this Thursday during lunch. Chinese lunch will be provided. And I hope you can make it. We're going to hear from some of our Stern classmates who have lived and worked in China. This session would be great if you are going on the DBI. And if you're not going on the DBI, come get dumplings. So I hear there are prizes. So come learn about China, and we hope you can make it. I will send the information to the GroupMe. Thanks.
Thank you. So a couple of announcements. One is that the quiz is day after tomorrow, in case you completely lost track of it. So the usual rules apply. You need to let me know before 10:30 on Wednesday if you're not going to take the quiz, first 30 minutes. And I'll send out the seating right after the class today, so you'll know which room to go to. So you'll have 260 in this room again. The second is, as you remember, I told you about the early final. The demand for it is vastly exceeded my expectations. I mean, I capped it at 60. It's now at like 70 something, which is obviously not feasible in that room. Even 60 was getting crowded. So I was able to get a second room, and I'll split it. So if you signed up and you're freaking out because you have an airline ticket on the 11th and you're number 68 on the list, you're still going to be okay. But that does, I mean, obviously I'm not encouraging people to take the early. So if you can take the regular final, it's probably better. But if you have to take the early final, you now have enough space, even if you're number 68 or 69 on the list. The final project, and this is just a reminder way ahead of time, is due on the last day of class, which is May 8th, I guess, the last, it's 2 Mondays from now. It's not that far off from now. Okay? So last thing, the third quiz will cover everything through capital structure, which is like page 140. It's not everything, but the first part of packet 2 through capital structure. So it's all everything on capital structure. So make sure you look at optimal debt ratios, debt design. And if you look at the past quizzes, they're pretty good indicators of what this quiz is going to cover. Not maybe the exact same problems, but you get a sense of what the quiz will cover. One final point, I've scheduled a review session for tomorrow at 12. There is a chance I might not be able to make it to that review. If I cannot make it to that review, I will have to put the recorded review session up. I'll let you know by tomorrow morning how it's going, because I have an appointment at 9:30 somewhere and I have to get back here in time for the review session. But I'll keep you in the loop. So let's continue with our discussion of dividends. Kind of laid the table. Set the table for dividends in terms of what dividend policy looks like around the world. And let's go through the characterizations of dividends. Dividends are sticky. Remember what that captured? The fact that companies, once they start paying dividends, tend to pay either the same amount or stay on the same dividend policy. Dividends tend to follow earnings. They don't lead earnings, they're not contemporaneous. Dividends are affected by tax laws, and you're going to see this play out today when we talk about the trade-off on dividends. Dividends are increasingly being supplanted by buybacks around the world. You've seen it most in the US, but you're starting to see that spill over into the world. And finally, dividends vary across geographies. You see some countries pay higher dividends than others. So today I'm going to start out with a very simple proposition. Okay? You take a look at your company. You can measure how much it pays in dividends. And the question is, measure relative to what? So I'm going to give you the two most common ways in which people look at dividends and say, this is a high dividend, this is a low dividend, rather than the absolute number. The first is what's called the dividend payout ratio. It's a very intuitive measure where you take dividends and divide by net income. So if you have a net income of 150 million and you pay out 60 million in dividends, your dividend payout ratio is 40%. What does that measure? It measures the percentage of income that the company returns to its stockholders, but it's connected to a whole host of other measures. Like what? If you have a high growth company, you'd expect the payout ratio to be a lower number or a higher number? You expect it to be a lower number because you got to put more money back. So this number is going to come into play when we think about where a company is in the life cycle, what kind of growth you'd expect the company to be. So there's a payout ratio. So the payout ratio measures the percentage of net income that the company pays out as dividends. You also have a dividend yield, which is the dividend paid divided by the market cap, or the dividend per share divided by the stock price. What does that measure? It measures the return you as a stockholder will get from dividends. The rest of your returns have to come from price appreciation. So let's see what those numbers look like. And if you actually have a sense of what your company's payout ratio and dividend yield are, you can get a sense of where your company falls in the broader cross-section. So at the start of 2017, as I've done for most of the last 20 years, I took every company that's publicly traded and I computed the dividend payout ratio for the company. What is it again? Divide dividends by net income. Already you're going to see the mechanics of what can potentially give you trouble. If you have a company with negative net income, it's losing money and it pays a dividend, the dividend payout ratio is not meaningful. I can't divide a positive number by a negative number and say the dividend payout ratio is minus 53%. So you're going to lose companies that have negative income and pay out dividends. If your dividend is zero, your payout ratio obviously is zero. So this is the distribution of dividend payout ratios across companies that actually pay a dividend. That sounds like a strange way to characterize what I'm going to show you, but there's a trick question that's coming after this. So I took every company, 42,668 companies, I computed the dividend payout ratio. And among the companies that pay dividends, you can see that the median payout ratio is captured by region, but it's about maybe 30, 35, 40%. So what does that mean? If you have a company with a payout ratio of 50, 60, 65%, your company is paying out more than the typical company in dividends. Doesn't make it a bad company or a good company, it just pays out more than. If your company pays out 5%, 10%, 15%, it pays out less than the typical company. And you can see that the median payout ratios vary across regions. Australia, New Zealand, and Canada have companies that pay out almost 54%. If you look at the median payout ratio, it's about 59.5%. Of earnings as dividends. Japan had the lowest dividend payout ratio of 26%. The US was somewhere in the middle. In fact, the US emerging markets and developed Europe all have payout ratios between 40 and 45%. But how did I characterize this? This is the median payout ratio among companies that pay dividends. There were 7,330 companies just in the US. 4,500 of them did not pay dividends. So here's a nice trick question to ask on an interview. What is the median payout ratio for a US company? What's the right answer to that question, given if I look across all US companies and 4,500 out of 7,300 don't pay dividends, the median payout ratio is 0. There were 3 people in my room last week. There were a lot of other people in the room, but the 3 people who came into the very specific question, they said, should I switch companies? You know what they had in common? Their company did not pay a dividend, and they were afraid that because there were no dividends, that they could not do the project. Is the policy of not paying dividends a dividend policy? Absolutely. You can ask the question, does it make sense? Does it not make sense? So if your company does not pay dividends, the first thing to remember is you're the rule, not the exception. In fact, it's the people who pay dividends who should be coming and saying, should I change companies? I have a strange company. It's actually paying dividends. Most companies in the US don't pay dividends. And it's reflected in a 0 payout ratio. Let me take this graph though, because there are a couple of there's a group of companies here that you can look at and say, are these companies insane? You know, which part of this graph is a payout ratio greater than 100%. Okay? Before you decide, some of them might be insane companies, but before you do that, here's a question I want to make sure we get answered. Can you think of good reasons why a company might pay out more than 100% of its earnings as dividends in 2016? I'm sorry? Too much cash from previous years? Okay. So you have too much cash from previous years and you're just overcompensating. The only problem with doing that, though, is remember, once you start paying these higher dividends, you have to continue. So if that's the reason, then make sure that you have the enough.
Did you say last week that there's a time lag too?
If you're a commodity company or a cyclical company and your earnings go up and down, you see what's going to happen? You're setting dividends based on what you make in a normal year. So if you have an economic cycle or a price cycle that pushes your earnings down, you will pay more than your earnings as dividends, not because you're insane, but because you expect your earnings to bounce back. And what's the gravest risk you face if you're an oil company hoping that that will happen? If the cycle either stays low for an extended period or it doesn't bounce back to what you thought it would, then you might have to revisit it. But again, you can see why commodity and cyclical companies can have payout ratios greater than 100%. So it could be companies with cash built up from previous years. It could be commodity or cyclical companies. There's one other group. Yeah. It could be a fixed dividend in a bad year, which is a variation of the commodity cyclical, right? Your earnings have dropped, but you expect them to bounce back, so you've kept your dividends high, hoping that the bounce back takes care of it. What if I told you a company is paying more than 100% of its earnings as dividends, and I expect it to do it for the long term, and it's in fact doing exactly what it should be doing? What kind of company would that be? Yeah.
At the end of its life cycle?
Remember we talked about corporate life cycles? You are in your, I was going to say your death march, but that sounds morbid. But you're in that phase of your life cycle where your business is shrinking. What should you be doing? You should actually be returning more, because in a sense, what are you doing when you pay out more than your earnings as dividends? You're partially liquidating yourself every year and making yourself a smaller company. That's exactly what you should be doing if you're a company that's declining. In fact, there are a lot of people who wish Yahoo had done that over the last 6 years rather than pump $1 billion into Tumblr and have nothing to show for it. So just because your company pays, and this is really for you, when you look at your company and it has a payout ratio more than 100%, don't freak out yet. Check to see if it's a kind of company you'd expect to pay out more than 100%, and if it is, this is exactly what you should be seeing at this stage in the life cycle. So the more than 100% payout ratio is not that uncommon. I mean, it's a fairly large percentage of companies, almost 16% of companies globally, 16% of companies in the US and about 14% of companies globally pay out more than 100% of their earnings as dividends. So that's a payout ratio. Let's look at the dividend yield. The dividend yield, as I said, is the percentage of your returns that come from dividends. Remember the way we think about expected returns on stocks. We take the risk-free rate, we take beta times the risk premium, we come up with this expected return. For most companies, it's 8%, 9%, 10%. This is the portion of that return that comes from dividends. Again, let's look at the median statistics. A median dividend yield for a US stock is 2.12%. Now I'm going to give you a value investing pitch, and you tell me what's wrong with my pitch, because there is something wrong. I've heard this pitch from old-time value investors. They say US stocks are incredibly expensive now because the dividend yield today is only about 2%. It used to be 4% 25 years ago. Part of that statement is true. It did used to be much, much higher if you go back to the 1980s. 1981, the dividend yield for US stocks was 5, 5.5, maybe 6%. Tell me what I'm missing when I make this pitch. Yeah. Well, but I had price appreciation then as well, so holding all else constant, why would I accept a lower dividend yield today than 30 years ago? That might be a tough counter, because I can't really present you an argument that real growth is higher now than in the 1980s, right? I mean, in a sense, it's a mature economy. So if growth is the reason, then we shouldn't be buying stocks. Yes? Higher inflation when? Then or now? And what could I point to that captures that higher inflation?
Just the U.S. Treasury.
You got that, right? Basically, the T-bond rate in 1981 was 10%. I made a 6% dividend yield, but if I didn't buy stocks, I could invest in T-bonds and make 10%. Today, I have a risk-free rate of 2.5%. So it's almost, if risk-free rates come down, you should expect to see dividend yields come down, and that's exactly what you've seen in the market. So the median dividend yield across much of the world is about 2%, and then you get to developed Europe and Australia, and you see a higher dividend yield. So let me ask you a question. Do you want to take all your money out of US stocks and put them in Australian stocks? It looks good, 3.84% dividend yield. But many of those companies are commodity companies that are paying dividends, hoping and praying what will happen? That prices will come back up. Investing in the entire Australian index, the Canadian index, has become almost a bet on commodity prices. If they come back, you're going to be good, because those dividends are going to be sustained. If they don't come back, there's going to be a day of reckoning where these companies have to step back and say, hey, we can't keep paying the dividends that we did. But here again, remember, most companies don't pay dividends. And here's what I think we're missing with both the payout and the yield. We're focusing on actual dividends paid, right? But already we've said that 60% of the cash returned by US companies last year took the form of buybacks. So the real question that should be asked is, why do we stay with a dividend payout ratio? Why shouldn't we be looking at dividends plus buybacks over net income? In other words, you could modify these payout ratios to capture total cash return. It's a statistic I have taken to computing, but it's also a much more volatile statistic than the dividend statistic, because the buybacks bounce around more. But it's something to think about. The next time somebody talks about payout ratios and dividend yields, in the US in particular, point out to them how much you're missing by focusing on the actual cash return. And so you take a company like Apple, you say, I can only a 2% dividend yield. That's not true, because for every dollar they return in dividends, they've been buying back $2 worth of stock. So you have to start thinking about buybacks, at least implicitly, when you think about these numbers over time. So let's get that life cycle story back on the table. Yes?
Just a question about companies paying back investors. What do you think about paying for R&D instead of, returning the money to shareholders?
When you pay for R&D, who's paying for the R&D? It's investor money. Companies are just legal entities. When you say companies paying back investors, it already strikes me as not the right way to think about it. This is your company. This is your cash coming back to you. They're not doing you a favor. This is your cash. And if you feel that they can invest this cash better in R&D and projects, what are you going to do? You're going to say, keep the cash, don't give it back to me. When are you going to ask for your cash back? I mean, think like an owner of a business. You've invested in a business. When do you want to take cash out of the business?
Probably when I don't trust management.
Exactly, right? So in a sense, when you think about companies that invest a lot in R&D, I mean, think about Amazon, right? It's never paid much in dividends. It reinvests huge amounts back into the company. Do you see its stock price being punished for doing it? I mean, it's a stock that's gone up to $750 from nothing. So this notion that investors are short-term and want their cash back, and companies are long-term and want to reinvest money, doesn't strike me as the description of reality out there. Some companies, obviously, you see investors getting impatient, but I think for good reasons. So if you want to invest in R&D, you know what you need to show me? That you're doing good R&D, that you're turning out revenues and profits from the R&D. And if you can do that, I don't think you'll have any trouble with your investors saying, we're going to reinvest that money back in R&D. So this notion that dividends and reinvestment are at war with each other doesn't strike me as the way in which the market treats these companies. Some companies, it lets them reinvest a lot. Some companies, it pushes back.
It's more like a lack of confidence.
It's a lack of confidence. And think, as an investor, would you trust some companies with your cash? And you can put names on those companies. United, how about? After they did that, you say, maybe I don't trust these companies with cash. Because it spills over. Credibility on one level affects you on other levels. So you earn the freedom to go out and do the things you want to do as a company. The way you earn it is by delivering good returns. So let's talk about the life cycle. And you've seen this life cycle picture before. You have a startup, you have a growth company, you have a maturing company, you have a mature company, you have a declining company. Already you can see dividend policy is going to shift as you look at where the company is in the life cycle. You shouldn't expect startups to pay any dividends. How can they? They're losing money, they're needing huge amounts to reinvest. There should be no dividends. You should not expect growth companies to pay much in dividends either, because even after they start making money, they have to reinvest a lot to get the future growth. But then as growth companies mature, as with debt capacity, what's going to happen? Your capacity to pay dividends opens up. You see why I described it as capacity to pay dividends? Because your income keeps growing, your reinvestment needs start to drop, and you realize you don't have as many great projects as you did. Now, when companies first start to see excess debt capacity, what did we say they try to do? They try to fight it, right? They say, we want to go back to being growth companies. They don't want to borrow money when excess debt capacity shows up. The same thing is true for dividends as well. When your capacity to pay dividends first opens up, you as a company fight it because you don't want to be a mature company. It's not even that you don't want to pay dividends. You're afraid of the signal it's sending to the rest of the world about you no longer being a growth company. It's like wearing reading glasses. I was lucky enough not to need any glasses to the age of 48. And I go into the ophthalmologist and he says, you need to wear reading glasses. And I said, I don't like to. And he says, why? And I said, because it makes me look old. But the reality is without them, I can't read now. So I don't care now. I put reading glasses on top of reading glasses because without it, I cannot read a thing. But that's what happens. Companies initially, when they get this capacity to pay dividends, will fight it. And how is that going to manifest itself? When a company that can pay dividends doesn't pay dividends, what are you going to see accumulating on its balance sheet? Cash balances. In fact, that's the easiest sign to find companies, growth companies that have kind of outgrown their growth, is start to see big cash balances that get bigger every year. And as you get into a mature company, at some point in time, you decide that you have to act your age, you pay your dividends, and then you go into decline where you could potentially even see dividends exceed earnings. So here's a very simple backing for that statement. I took every US company and I broke these companies down, so all 7,330, based on the expected growth in earnings for the next 5 years. It's a very simple proxy for where you are in the growth cycle. And then I looked at both the payout ratio and the dividend yield by grouping. So let's start. When you have a really low growth company, the payout ratio and the dividend yield are both really high numbers. And as the growth increases, you see both payout ratios and dividend yields drop off. So as you look across your 5 or 6 companies in your group, here's a simple way to see if their dividend policy makes sense. Just classify them based on where these companies, and if you have young companies and more mature companies in your group, you should see dividend policy kind of reflect where the company is in the life cycle. So before I look at the 3 schools of thoughts on dividend, I'm going to take my 5 companies, my 5 publicly traded companies, and look at what their dividend policy looks like. And then we'll come back and ask, are they paying the right amount in dividends? So let me start with the easy one here. Of my 5 companies, the easiest one to analyze in terms of dividends, of course, is Baidu, which has 0 dividends. So the dividend yield is 0, the dividend payout is 0. Don't worry, we'll have to come back and ask of Baidu, is that the right dividend policy for them? But at least in terms of calculating yield and payout, it's 0. Tata Motors and Disney have dividend yields and dividend payout ratios that look very similar to their yields and payout in the previous 5 years. So it looks like they're paying what they used to. And then you look at Vale and Deutsche, and your reaction is, what the heck is going on here, right? If you look at Vale, the dividend yield is 6.56%. The dividend payout ratio is 113%. See why, right? It's a commodity company. Iron ore prices are down. So what are they doing? They're hoping that iron ore prices will go back up. So they're keeping the dividends high. You know, in 2015, they finally had to cut dividends. Why? Because iron ore prices stayed low. And eventually they had to wake up to the fact that they could not sustain those dividends. And iron ore prices were not coming back quickly. But in 2013, you can see that the payout ratio and dividend yield were reflecting their past history, basically how much they used to make. And with Deutsche, The dividend yield was almost 2%, but the payout ratio was 362%. What's going on here? I wish they were liquidating, right? In a sense, you wish they were liquidating, but they're paying dividends saying this was a bad year, we're going to bounce back, everything's going to be okay. The only problem is 3 years later, it got even worse. And now they're issuing $8 billion worth of equity. In a sense, they continue to pay dividends well after that due date when they should have stopped and saying, no, because they were in trouble starting in 2011. This is 2013. They're continuing to pay dividends. Banks are among the worst culprits when it comes to sticky dividends. They will not abandon dividends till the very last moment, and you see that reflected in Deutsche. So we'll come back and look at each of the 5 companies and ask, are they doing the right thing? And already you can see the seeds for what I'm going to say about Vale and Deutsche. They're paying too much in dividends, but we have to take a deeper look before we make that judgment. So you ready? We're going to look at 3 different schools of thought about dividends. The first school of thought says it doesn't matter what you pay in dividends. Does that sound slightly familiar? When we talked about capital structure, didn't we say it didn't matter how much you borrowed? This is Miller Modigliani 2. Basically, it says it doesn't matter how much you pay in dividends. You think that's absurd. Why does it not matter? Here come the caveats. If you live in a world where there are no tax differences between dividends and capital gains, in other words, you're taxed exactly the same way as an investor on price appreciation as dividends, and companies can go out and raise capital whenever they want with no flotation, transactions cost, it doesn't matter how much you pay in dividends. And I'll come back and back it up. So that's the first school of thought. It doesn't matter what companies pay in dividends. The second school of thought says don't pay dividends. They're awful. Why? Because investors, when they receive dividends, pay a much higher tax rate than they do on capital gains. And remember, for much of US market history, that was true. So the dividends are bad school actually had a pretty strong foundation, especially pre-2003. So dividends don't matter. Dividends are bad. Let's round off these by bringing in the third possibility. There's a third school of thought says that dividends are good. And the more you pay, the better. Why? Because there are some investors who like dividends, and if they happen to be the investors in your stock, you should give them even more dividends. And we're going to see some evidence that this is in fact true, that you attract investors who like what you do. So if you attract investors who like dividends, then your job is to deliver more. This is incredibly convenient if you're a CFO. Do you see why? No matter what you do, you've got an entire school of thought backing you up. You want to cut dividends, you point to the dividends are bad school. You want to increase dividends, as the dividends are good school. You have no idea what you're doing about dividends, you claim to be in the Miller Modigliani school. Incidentally, if we lived in a Miller Modigliani world, we could have ended this class after the week 9, right after we did the capital budgeting. Because in a Miller Modigliani world, all that matters is taking great projects. And there is a kernel of truth there, right? Because if you think about the great companies around us, the Googles, the Facebooks, think about how they became great. It wasn't by optimizing capital structure. It wasn't by finessing dividend policy. It was by taking great projects. So there is a kernel of truth in the Miller Modigliani statement that we should take to heart. Is if you take great projects, everything else will be forgiven. You can have a suboptimal debt ratio, a horrible dividend policy, and I'm going to be okay with it. So let's take each of these schools of thought and see what the basis is. Before I do that, though, I'm going to argue that there is some truth in all 3 schools of thought, and I'm going to try to come up with this 4th school of thought that tries to bring them all together. And I'm going to make my statements in very intuitive terms. And here's what I'm going to claim. If you're a company which has lots of cash coming in and not very many good projects, I want you to give more cash back to your stockholders. Does that make sense to you? If you're a company with not much cash coming in and lots of great investment opportunities, don't return the cash. Let's not make this more complicated than it has to be. That's going to be the basis for how I think about dividends. But so let's revisit these 3 schools of thought. Let's start with the Miller Modigliani school. The Miller Modigliani world, basically, there are no tax differences between dividends and capital gains. So you as an investor are indifferent between receiving $1 in dividends and $1 in capital gains. You're either not taxed on both, or you're taxed at exactly the same rate. So if you're an investor and I say, should I pay a dividend? Your reaction is, I don't care. Because if I have a $50 stock, remember the example we used, a $50 stock, If I don't pay a dividend, you get it entirely in capital gains. But if I pay $1 in dividends, here's what happens. Your stock price drops to 49. You replaced $1 in capital gains with $1 in dividends. You're saying, because I get taxed exactly the same way, it doesn't matter. But then you're saying, what if a company pays too much in dividends? That must matter, right? In the Miller Modigliani world, if you pay too much in dividends as a company, why do I not care as an investor? What are you going to be able to do? You're going to be able to go out and raise fresh equity. You're not paying any transactions costs. So here's what happens. Your stock price will drop more, but you will get a bigger dividend. So no matter how I slice the pie, you will end up with the same return as a stockholder. The only difference is how much of that return will take the form of dividends and how much will be capital gains. So when you look at MLPs and REITs, you'll often notice these incredibly high dividends, and many of them will issue shares at the same time to grow. And you're saying, why do investors not care? If you lived in a Miller Modigliani world, you can see why. You get a bigger dividend yield, a lower price appreciation, but the total return remains unchanged because I'm assuming you as an investor are indifferent between receiving dividends and receiving capital gains. So the Miller Modigliani world sounds absurd because of the assumptions, but it gives you the limiting case. For companies where investors are not taxed on dividends and capital gains and have access to capital markets, dividend policy should matter a lot less. So if you're a large market cap company with a lot of investors who either don't get taxed at all or get taxed at the same rate, maybe you shouldn't care that much about what you pay in dividends. Now let's look at the second school of thought. I said the basis for the second school of thought was the way dividends used to be taxed in the US. So I'm going to show you a picture that shows you how much we used to penalize dividends for much of market history in the US. So what you see in the purple line is actually the tax rate on dividends. This whatever color, the blue-gray line is the tax rate on capital gains. So if you look since 2003, the two have the same tax rate. Dividends and capital gains have been taxed at the same rate. You know what the rate on dividends and capital gains is now? Somebody must have filed their taxes last week. Do you remember what you paid? You always do an extension, so that's good. Huh? Which means that you owe taxes rather than receive them because there's a self-selection process, right? So does anybody know? It was 15% after the Bush tax reform. What is it now? I'm sorry? Dividends and capital gains are treated as investment income now, separate from ordinary income. So actually, it's without knowing the tax rate, we shouldn't even be talking about dividend policy. It's 20%, but that's a little. It's 20% plus the HCA, the Healthcare Act tax, which is another 3.8%. It's 23.8% on dividends and capital gains. So that's the tax rate on dividends and capital gains. But that's been true only since 2003 that they have the same tax rate. Let's go back to 1960. 1960, dividends were taxed as ordinary income. They were taxed at a 90% rate, the highest marginal tax rate. Capital gains were taxed at 28%. Let me ask you a question. Would you rather receive income on which you're taxed 90%? Would you rather receive it? Now do you see why the dividends are bad school had such a strong following pre-2003? It doesn't take a whole lot of intuition to argue, why would you ever pay dividends if investors get taxed at 90%? It's a little bit of a deception here because this is the highest marginal tax rate. It is conceivable that the companies that paid dividends were paying them to investors with much lower, but you can see that leading up to 2003, dividends were taxed at a much higher tax rate than capital gains. So one of the questions you'd like to look at in your company is what kind of investors do I face and how do they think about taxes on dividends and capital gains? Remember I told you that the tax rate on dividends and capital gains has converged, 23-point-something% now. As an investor though, I'm going to still argue that you get an advantage with capital gains in terms of taxes that you don't get with dividends. What is that advantage? Even though the stated tax rate is the same. And explain to me what you mean by paying taxes later.
With dividends, you don't have a choice of when you pay your taxes.
in fact, let's pause there. You pay taxes for dividends the year that you receive the dividends. You get that form from the company saying we paid, or from your brokerage house saying you got X million dollars in dividends. The fact that you didn't spend it, you can't tell the IRS, you know what, I got the dividends, but I wasn't planning to spend it this year, so I'm not going to pay taxes this year. I'll spend it 7 years from now. It doesn't work that way. You have to pay taxes right away. And when do you pay taxes on capital gains? Whenever you sell. There's a timing option you have with capital gains that you don't have with dividends. You see, who cares? If your income goes up and down over time, your tax rates vary across time. See why the timing option could be valuable? Because you get to decide when you're going to take the capital gains. You're going to take it in a year when your tax rate is low, rather than when the tax rate is high. So even though the stated tax rates remain the same, there can be an argument that there are still investors out there who feel that there's a bigger tax disadvantage associated with dividends than with capital gains. So here's one question that I'd like to know the answer to. I'm a company, I have lots of investors out there. I'd like to ask them individually, what's the tax rate you pay on dividends and what's the tax rate you pay on capital gains? The only promise, nobody's going to agree to answer that question from a company. So there's a little trick that actually helps you back out what your investors think about taxes on dividends and capital gains. And it boils down to a day in dividend policy called the Ex-Dividend day. That's the day by which you have to buy the stock to collect the dividend. So let's play a game. Let's suppose we're all investors in a company, the same company. We all bought our shares 5 years ago, so that makes it long-term capital gain, right? So let's assume you all bought the shares at $5 5 years ago. The stock is up to $20 today. Tomorrow is going to be an ex-dividend day, and there's going to be $1 in dividend coming on the ex-dividend day. So here are your choices as an investor. You can sell before the ex-dividend day and get a price. Let's call that PB, price before the ex-dividend day. You can wait till after the ex-dividend day and sell it at a different price. You're going to see why it has to be a different price. Let's call that PA. Let's see what your cash flows will look like if you sell before the ex-dividend day. If you sell before the ex-dividend day, you get the price PB, but you won't get the dividends because you sold before the ex-dividend day. And you're going to pay the capital gains taxes on whatever the difference is between PB and the original price you bought at. If you hold through the ex-dividend day, you're going to get PA minus the capital gains taxes on the PA, plus now you get the dividend on which you will pay a different tax rate. For the moment, let's treat them as being taxed differently. You're saying, why are we even spending time on this algebra? Hang in there. So basically, you have a choice between selling before and receiving the cash flow you see at the top, and selling after and receiving the second cash flow. For this to be a stable market, most investors should be indifferent between selling before and selling after. Do you see why? If every one of you got a higher cash flow from selling before, what would happen? You'd all sell before, you'd push down the price, right? If all of you got a higher cash flow from selling after, nobody would sell before, everybody wants to sell after. So for this market to be stable, those two cash flows have to be the same. So I set them up, and I saw that you can't even see the bottom there, for some reason. But if you take the change in the stock price on the ex-dividend day, that PB minus PA, and divide by the dividend on that day, you're going to get a rough measure of what kind of tax rates I pay on dividends versus capital gains. Okay? So you observe the ex-dividend. Remember, it's a $1 dividend. I look to see what happens to your stock price on that day. If it drops by exactly $1, which is my dividend amount, I'm going to say you are indifferent between dividends and capital gains because effectively the tax rate must be the same. But if you're taxed at a higher rate on dividends than you were on capital gains, like the US investor was pre-2003, here's what you should expect to see. On the ex-dividend day, the price will drop by less than the dividend. Intuitively, think of what? If you're going to get taxed at a higher tax rate, you're okay accepting a lower price appreciation instead of the higher dividend because you think in after-tax terms. So by observing what happens in the ex-dividend day, I can at least get a window on what kind of investors you have. So here's what I'm looking for. If dividends and capital gains are taxed equally, I'll expect the price change on the ex-dividend day to be equal to the dividend. If dividends are taxed at a higher rate than capital gains, then the price change should be less than the dividend. But there are parts of the world where dividends are actually taxed at a lower rate than capital gains. There are some countries where dividends are tax exempt and capital gains are taxed. And if that's the case, the price change can be higher than the dividend. So I'm going to do some reverse engineering because I don't know who your investors are. I kind of ask them what their tax rate is, but I can observe what happens in the ex-dividend day. I'm going to back out from that what kind of investors you have. So I'm going to give you some statistics from the US market on this particular number, the price change as a percent of dividend. The very first study was done in the late 60s, and here's what it found. The price change as a percent of dividend was about 78%. So if you had $1 in dividend, on the ex-dividend day, the stock price dropped by about 78 cents. But those are also the times when ordinary tax rate was 70%. That's what your dividends got taxed at, and your capital gains rate was 28%. Huge difference between dividends and capital gains in terms of rates, and you see a price drop much lower than the dividend. That study was updated in the early 80s. The tax difference had narrowed somewhat because the ordinary tax rate had come down to 50. The capital gains rate was 20%. Price change was now 85% dividend. As the tax rate difference has narrowed, the price change has gone. 1986 through 90, which was the only period in the last century when you actually had the same tax rate, 28% on both. Because Congress promised us that they were going to simplify our tax code and not have all these different tax rates. They very quickly deviated from that script, but from 86 through 90. But even during that period, even though the tax rates were the same, the dividend and price change didn't equate. And you can see why. We talked about even when the tax rates are the same, you have this tax option or timing option you have with capital gains that you don't have with dividends. I've seen one updated study from the last decade, like 2006 through 2010. The price change now is about 93% of the dividend. We're getting very close to a dollar for dollar dividend change, but it still remains smaller than the dividend. So I want you to put your arbitrager hat on, and you're going to try to tell me how you're going to try to make money. Because this is a general finding across all US companies. On the ex-dividend day, the price drops by less than the dividend. I want you to tell me, as a tax-exempt investor, how you would try to exploit this difference between the price change and the dividend. Okay? So you're tax exempt. You pay no taxes. What kinds of investors are tax exempt in the US? There's a very big chunk of institutional investors who don't pay taxes. Pension funds collectively don't pay taxes. So if you're a pension fund, you don't pay taxes on dividends. So you're a pension fund manager. You know, or you've seen these statistics that the dividend drops, the price change is only 90% of the dividend. Tell me how you would try to make money off this phenomenon. What would you do? So tomorrow is going to be an ex-dividend day. It's going to be a $2 dividend or $5 dividend. You know the price drop is going to be only 90% of the dividends. So what are you going to do just before the ex-dividend day? You're going to buy the stock, and then you're going to sell it right after the ex-dividend day. And what do you get out of this? Because the dividend is larger than the price drop, you should be able to make some money, right? This is called dividend capture. It's not an uncommon strategy. And the way to actually see this is take a big dividend paying stock, and on the ex-dividend day, you will see the trading volume jump 8 or 10-fold. That's all those people swooping in on the stock trying to collect that dividend. And you got to do it in big terms. You can't do 5,000 shares. There's not enough money to do this. So here's an example of how this would work out. Let's say you have a stock that's trading at 50. Tomorrow's going to be an ex-dividend date, and the dividend is going to be $1. You know by now what the dividend is. There's no uncertainty about the dividend. You go out and buy 1 million shares of XYZ stock, cum dividend. That's before the ex-dividend. You pay $50 per share. You hold it through the ex-dividend day. The stock drops to $49.10 if the 90% drop works out. You collect the dividend, and your net profit from this will be $100,000. You're saying, only $100,000? If you can do this on a large enough scale in enough stocks, it can augment your returns. Is there any risk to this strategy? What's the biggest risk?
The price drops more than the
No, tomorrow could be October 19th of 1987. There's actually a story around that. There's a story in the mid-'80s. Some pension fund manager in Oregon saw the study of price drops, and he got very excited. And he took all of his pension fund money, the entire pension fund, and bet it on one stock on one ex-dividend day, which unfortunately for him happened to be October 19th of 1987. And that's the day where the S&P 500 dropped 22% in one day. No study is ever going to hold up here, right? If the market is down 22% and you pay $1 in dividends, my stock is not dropping by 90% of that dividend. So if you're going to do this, you got to do it on a lot of stocks across time periods so you don't get slammed. But it does happen, and the best way to see it happening is look at the trading volume on stocks around the ex-dividend day. So the dividends are bad school is entirely based on this tax argument. And you can already see it's become a much weaker argument since 2000. It's not gone away, but it's a much weaker argument now than it used to be. 15 years ago, 20 years ago, 25 years ago. And it might be even weaker if you go to markets outside the US where the tax laws are not tilted towards capital gains. Any questions on the dividends are bad school? Let's talk about the dividends are good school. Let's start by dispensing with 2 reasons I've heard for dividends which we should never hear as reasons for paying dividends. The first is what's called the bird in the hand fallacy. And here's what it says. Dividends are certain, capital gains are uncertain. Do you see what the argument is? That check in the mail, I can see what it is, but capital gains are in the future. They're uncertain. We don't know what they are. What's wrong with that argument? It sounds pretty reasonable that dividends are certain and capital gains are not. If I compare dividends today to capital gains in the future, you're right, dividends are more certain. But what should I be comparing those dividends to? I can get the dividends today, or I have to ask myself, what if the dividends were not paid and I just sold the stock at the end of the day? It's really dividends today and capital gains today. And that becomes a much more even trade-off. So I'm not asking you, would you rather have dividends now or price appreciation 10 years from now? I'm asking you, would you rather have dividends now or price appreciation now? And from that perspective, there's nothing more certain about dividends than capital gains today. So that argument really doesn't fly very far. Here's the second one. We had a really good year last year. Our revenues were up, the economy was doing well. So we're going to use that excess cash to pay a dividend. Sounds okay until you think through the next step. So you had a really good year last year, but let's say you're still a growth company. You might need to come back to the market next year, 2 years from now, 5 years from now to raise capital. If you pay dividends today, what do you need to do then? Come back and raise more capital in the future. You're saying, so what? What's the big deal? You don't live in a Miller Modigliani world. When you go out to raise capital, there are transactions costs, there are issuance fees. How big can they be? Well, depending on how big you are as a company, it could be 3%, 5%, or even 15% of your proceeds. A small company that has a really good year should be much more reluctant to raise dividends than a much larger company. If you're a company dependent on equity, you should be much more reluctant to pay dividends than one that uses debt, because those issuance costs have to be thought through when you think about paying dividends. So when you see a company hold back earnings, even though it has a really good year, I think it has a basis for doing it, because to pay those dividends out and then replace them with new equity issues, I think it'd be very expensive. So now let's close off by looking at 3 good reasons why companies pay dividends. The first I've kind of talked about, which is you get the investors you deserve. It's called the clientele effect. And what the clientele effect talks about is as you continue to, with whatever dividend policy you have as a company, you start to accumulate investors who like that dividend policy. There's a selection bias here. So if you have historically paid big dividends, you attract investors who like big dividends. And once that happens, you've got to continue to feed the beast. You've got to pay them more big dividends. We'll talk about what happens if your circumstances change, because that's going to be a problem. But the clientele effect says if you've accumulated investors who like dividends, give them more dividends. The second school of thought is one of the most dangerous ones in finance. It's called the signaling story. Okay? And I'll tell you why it's dangerous. This story, the basis for the story is when a company increases dividends, it's a good signal. Of what? That they have the future earnings to be. Remember we said dividends are sticky, that only companies that feel they can pay those dividends will start those dividends. So the signaling story says when companies increase dividends, it's a positive signal. When they cut dividends, it's a negative signal. What's shaky about the story? Can you tell me a story about a company that increases dividends? You've invested in the company and you view it as bad news. Could it be a signal of something bad? If you're a growth company and you increase dividends, the signal you're sending to the market is, hey, we don't have the growth. So the signaling story says, If you want to use dividends to signal that you have good prospects in the future, go for it, but it could blow back on you. And finally, and this is not a noble story, but I'm going to put it on the table anyway, dividends might be a great way to rip off your bondholders. I told you it was not a noble story. So if you have people who've lent you money as a company and they haven't put covenants on how much you can pay in dividends, you can hollow out the company by paying yourself dividends, and because it didn't stop you, you're going to transfer risk to them and walk away with the wealth. It often happens in LBOs. You see those big cash flows out of the company to the existing investors, and the existing lenders are left holding the bag. So let's take each of these schools of thought. Let's start with the clientele story. And I'm going to start the clientele story with one of the strangest studies ever done. In most academic research, researchers know what they're going to find before they actually do the researching. So it's kind of so you kind of get there and say, oh my God, this is such a surprise, but the reality is you've been expecting it right from the moment you pick this. This is one of those few studies where the researchers are completely flabbergasted with what they found. So let me set this up. It's actually a utility somewhere in upstate New York called Citizens Utility. Traditional regulated utility. What made Citizens Utility different, it had two classes of shares. Again, not uncommon in many companies, but these two classes were fairly unique. So let's say we're all stockholders in Citizens Utility. You guys are going to get Class A shares, you're going to get Class B shares. And here's what Citizens Utility does on the shares. On Class A shares, I pay a fixed dividend, $2 per share. And on Class B shares, I give them more shares in the company exactly equal to $2. So in other words, Class B shares just get more stock, more shares in the company, exactly equal to the $2. Now do you see how this is a classic lab experiment on what do investors want? And this was in the 1970s when investors were taxed at 70, 80, 90% on dividends and 28% on capital gains. So you see what the researchers expected to find, right? The Class A shares, you get a cash dividend. On Class B shares, you get an equivalent capital gain. They expected to run this study and come back and tell us that the Class B shares traded at a premium on the Class A shares because the Class A shares were being punished by paying large dividends. What they discovered instead was that in every time period they looked at these two shares, the Class A shares traded at a premium on the Class B shares. Given a choice between a 2% dividend and a 2% capital gain, people picked the 2% dividend shares. And in fact, the Class B shares could be converted to Class A shares. So the Class B shares had all of the advantage of being able to convert, but people still preferred the Class A shares with the cash dividends. How do you explain that? They actually dug a little deeper and they found the explanation, but how do you think you explain the fact that at least in this company, and that's very specific to this company, investors seem to like higher dividends? What kind of investors do you think bought shares in Citizens Utility? Were retired people. In fact, it was your cash cow stock. You were older people, retired people. And for the most part, many of these people didn't even pay. They were getting Social Security income, a little investment income. Many of them didn't even pay taxes. You can see very quickly why it's not a tax argument that's swaying them. And why do they like the cash? Because they don't have to call the broker and sell these were the days when selling small units of shares carried this big. So it gave them the convenience of the check in the mail. It gave them the predictability of knowing what that check was going to look like. And it didn't really carry the consequence of big taxes because of the types of investors. I wouldn't generalize from this. Now, all investors like cash dividends, but I would say that at least investors in Citizens Utility seem to like cash dividends. In fact, the study was expanded to a bunch of Canadian companies that have the same characteristic of cash dividend shares. And in every one of those Canadian companies, the cash dividend shares trade at a premium on the capital gain shares. So at least in these companies, investors who buy these shares really like cash dividends. Okay. So let's look at what sets these investors apart. What is it that leads some investors? So this was actually a follow-up study that looked across companies and tried to explain why, looking at the dividend policy, what was different about the investors in each company. So they looked at high dividend paying stocks and low dividend paying stocks, and they found that older investors, no surprises here, so you're not going to be surprised by any of these findings, older investors were more likely to invest in high dividend stocks. Poorer investors tend to, so basically older and poorer investors buy high dividend stocks. Younger investors who don't need the cash buy. So I would wager if you took Google's shareholding base and you looked at the age and the wealth of that base and you compared it with Con Ed's investor base, you'd get very different characteristics for the investors. That's what I mean. You get the investors you deserve. You pay big dividends. You're going to attract a subset of investors to your company who like those big dividends. You pay no dividends, you're going to attract, and that's why when people say, well, I'm going to change my dividend policy, attract new investors, my response is why? If you can't really live with those investors, don't go out and look for them, because they're now going to come into your company and demand the follow-up of more dividends because they came in for the dividends. Final piece on the clientele. Yep.
Did that study examine other factors that would be correlated with wealth and age that actually might...
They tried lots of other variables. For instance, they looked at what part of the country you were in to see if state taxes affected. These seem to be the two dominant variables that explained it. But they could. So when you say correlated, what are some of the things?
I mean, if you're poor, you have typically less information, or you're not reading as much as say someone who's wealthy.
All right.
Because you
Right.
know, for whatever reason, that's why you've not.
And also you have to put it in time frame, right? Which is in the 1970s. How do you get information about stocks? You had to read an equity research report that if you were poorer, you probably didn't have it. Poorer here is a relative statement. We're not talking about truly poverty-stricken. We're talking about people who are poorer and still can own stocks. Because remember, 60% of Americans don't have any stocks in their portfolio simply because they don't have the money. So poorer on a relative basis is really what we're talking about. And it's possible that information might not be getting to them because they don't have the information. They hold on to the one thing they feel certain about, which is, I have no idea what's going to happen to the stock. I'm just going to collect my dividend. So there might be other things correlated with older and poorer that might explain it. I haven't actually seen an update of this study because it might be interesting to see if this has shifted over time. Because this clearly used to be true 20 years ago, 30 years ago, 40 years ago. And finally, this last study actually looked across companies and looked at their dividend yield to see what kinds of variables seem to explain why some companies paid high dividends and others didn't. So I'll go down the list again, and if you sense any surprises, let me know. They found that higher risk stocks, and they captured risk with the beta, paid lower dividends than lower risk stocks. Let me pause there. Does it make sense to you? Yeah, higher risk stocks pay lower dividends. I'm not surprised. Higher risk often goes with higher growth, so basically that makes sense. They found that companies with older investors pay higher dividends, wealthier investors pay lower dividends. And they also threw in a variable that captured that macro effect, which is how much is the ordinary tax rate, the dividend tax rate, different from capital gains. And they found that across time, the bigger that difference, the less money was paid out in dividends collectively by companies. So there is a dividend clientele effect, which is you get investors who like your dividend policy. So I'm going to put you in a very, very bad spot. I'm going to make you the CEO of a telecom company. Make it Verizon. Or make it any other company that essentially, and the reason I'm picking those companies is these companies came out of AT&T, right? Verizon originally was a portion of AT&T that got spun off and made an independent company in the 1980s. And AT&T, for much of the last century, was the ultimate, I don't know what the right way to describe it is, older, poorer investor stock. It's a stock you bought because you wanted to collect the dividends. It showed up in retired people's portfolio, widowers' portfolio. I mean, basically, it showed up in anybody who needed the cash. So there's a history here. You used to be part of AT&T. I've spun you off. And when I spun you off, I gave you my investors, for better or worse, who are investors who liked big dividends. So you look at all the telecom companies, especially the older ones, they came out of a history of attracting dividend-paying investors. You're kind of stuck with them, right? So let's say you are one of those, the CEO of a phone company. You have all these investors who like dividends. You currently pay high dividends to keep them happy, but you realize the game has changed for you. Why? Because today's telecom company is no longer an old-fashioned phone, no longer a regulated utility. It's really a technology company with huge reinvestment needs and lots of risk. You see why this is going to be a problem? You're paying big dividends because that's what you used to do when you were a regulated phone company that had nice predictable earnings. Now those nice predictable earnings have become volatile earnings. You need a lot of reinvestment. You still have a dividend policy that reflects the old you. So So I'm going to give you some choices, and you tell me whether this is the choice you would take if you were the CEO of this company. You can go in front of your stockholders, and remember who your stockholders are, right? You can go in front of your stockholders and courageously tell them that you're going to cut dividends and reinvest more back into the company. Is that going to go well, you think? Those old ladies can be pretty vicious once they get going, right? With the handbags are coming after you. How dare you cut my dividends? Don't try this. You can only bad things can happen. Yeah.
I mean, if they don't like it, they're going to sell it. Your stock price is going to drop for.
Well, before they sell it, you might be out of it. So in a sense, there might be a trend. If it happens overnight, you're right. If that transition happens overnight, you're going to be okay. But what if it takes 8 weeks, 10 weeks, 12 weeks, 16 weeks for it to happen? And in that period, the board of directors meets and decides you're too big a liability and throws you overboard. It's a risky strategy because you're hoping the transition happens and then good things start to happen to you. And some companies have tried this and they've been able to live through it. Some companies haven't. I'll give you an example of what happened after a really big dividend cut at a company that everybody agreed was paying too much in dividends. And it took a while for that transition to happen. Okay? The second thing you can try is you can continue to pay the dividends. This is the opposite of the courageous strategy. You pay the dividends that you used to. You defer investment in the new market, saying one of these days I will be able to take those investments. Not a great way to run your business because you're not reinvesting in a business where you need to reinvest. You could try to have your cake and eat it too. You can continue to pay the dividends that you did, take the investments you want to take, and now issue stock or raise fresh capital, take those investments. And a lot of companies did this as well. But can you think of a creative strategy where you can essentially deal with the fact that at least a portion of your company has now become a risky technology company and it cannot afford to pay dividends? Can you break yourself up into two companies? Essentially, you can have an old phone company which makes regulated income and you pay the big dividends. And in this case, you basically give stockholders a choice. Do you want to stay with the old company or go to the new company? And you're very clear up front that if you go to the new company, here's what it's going to come with. No debt, no dividends, a very different company. Now, I'm actually surprised that more of the old telecom companies did not adopt this strategy early on because they got squeezed by trying to be all things to all people, by continuing to pay the dividends that they did and face these very new realities of a lot more risk and a lot more reinvestment than they did. So when you look at companies that have established clienteles, most of the time you're going to be okay until you get into trouble. And this is exactly why banks and oil companies are in trouble right now, is over time they've accumulated investors who love big dividends. They know they can't afford these dividends anymore, but they can't think of an easy way to get out of this trap because somebody's going to be really pissed off at you. So that's a clientele story. Okay? Let's talk about the dividends as a signal story. This is actually a very old study. It's almost 30 years old. And here's what it looked at. It's a very simple study too. It looked at the date on which a company announces it's either going to increase dividends or decrease dividends. This happens about 4 weeks before the actual ex-dividend day. The board of directors gets together and says, we're going to increase dividends by 20% or we're going to cut dividends by 15%. So what this study looked at is what happened to the stock price of the company on the announcement that the dividend would be increased or decreased. So let's start with the dividend increases. When the company announces an increase in dividends on the ex-dividend day, so the AD is the announcement, on the announcement date, here's what tends to happen. The stock price jumps about 1%. So don't get too excited about it, but it's on average good news. So when dividend increases are announced, the stock price jumps about 1%. When dividend decreases are announced, on average, on the announcement day, the stock price drops by about 5%. What did it go up by when you announce an increase in dividends? 1%. When you cut dividends, it drops by 5%. Why such an asymmetric impact? Why is a dividend cut so much worse news than a dividend increase is good news, you think? Yes?
So the court shows to them that the company is in distress, so they start to panic.
But am I not also sending a positive signal that I'm doing really well when I increase dividends? So my question is, why is that cut so much more of an creating so much more of an impact than an increase? Both are signaling stories, but it seems like that negative signal I set by cutting dividends is so much bigger than the positive signal that I get by increasing dividends. Yes?
Maybe companies really don't like sharing bad news, but like sharing good news, so they're more likely to be surprised by a cut.
Right. And is there a graph I could go back to that could back this up? Remember when you looked at dividends as sticky, what do we look at? We looked at the percentage of companies that increased dividends, the percentage that decreased dividends. I don't know which page that was. I don't want to flip back and lose this page. But if you go back and look at this page, we found that about 5 times more companies increased dividends and decreased dividends. In other words, companies hate sending this bad signal, so they hold back, but they don't mind sending you small positive signals. So not surprisingly, when you cut dividends, markets read a lot more into it than when you increase dividends because it's so much more uncommon. So this is the basis for the dividend signal. Right? But here's the downside of the signaling story. I told you that there are some companies that you might be investors in. When that company announces a dividend, you might actually freak out and say, this is really bad news. So let's say you bought shares in Snap 3 weeks ago. You've been doing pretty well. And why do you buy shares in Snap? Because of its established businesses and lots of cash flows? No, you're buying it on growth potential. The company announces that it's going to start paying big dividends next quarter. What's your reaction? Something is off here, right? I bought this company expecting huge investments in the future. Instead, they're announcing they're going to return cash. This is not good news. It is in fact conceivable that in companies that increase or at least initiate dividends for the first time, that this is actually a signal that your best days are behind you. And here's some very kind of loose evidence to back it up. So what this study looked at was companies that start paying dividends for the very first time. And they graphed out earnings growth for this company leading into the dividend initiation and afterwards. So the way to read this is in the 4 years before they start to pay dividends, you can see that earnings continue to grow. In fact, they peak the year before the dividend is started. But you go after into the following years, you start to see earnings growth go off. So once you initiate dividends, it's not like the dividend initiation is what's causing earnings growth to drop. It's that these companies know that their best days are behind them and they start paying dividends to reflect the fact that their growth is dropping off. So what I'm saying is when somebody gives you a dividend signaling story, I can very easily turn it around and argue that it's not a positive signal. It's in fact a negative signal, at least in some companies. But to kind of bring it all to fruition, I actually looked at a set of studies that looked at how much impact even that initial study had, but looked across time. So basically, the first study that was done from 1962 to 74. The impact of a cut in dividends was much bigger than an increase. That study was replicated 75 through 87, 88 through 2000, and I just saw a study last week that looked at the last decade. What do you see across the 3 graphs? Both the negative and the positive impacts are getting smaller, right? So dividends, if they're a signal, are becoming a less valuable signal than they were 20 years ago, 10 years ago, 30 years ago. Why do you think that is? Why are dividends a less valuable signal now than they used to be? Goes back to the point made earlier. Yeah.
Today there's so much news about finance and everything.
Yeah, you go to Yahoo Finance, you can go look it up. 30 years ago, if I wanted to find out more about a company, I was digging through. So in a sense, as our information resources have improved, maybe dividends are not the best way you want to say. Maybe there are better ways, less expensive ways of doing it. But you can see that the effect of dividend announcements has become much smaller. I wouldn't be surprised if it continues to decrease over time because investors are less focused on that signal. They've got so many other signals they can see to know that you're in trouble before you actually cut or increase dividends. So if dividends are a signal, they're becoming a less powerful signal over time as the markets are changing and information becomes more available. Which brings me to my third reason for paying dividends. Remember I gave you that graph where dividends or increased stock prices went up? This study actually then looked at the second question. We know that on average increases in dividends increase stock prices and cuts in dividends decrease stock prices. So what this study looked at is what happens to a company's bond price at that same time. So let's say a company announces an increase in dividends. Your stockholders, you're pretty happy you push up the price because you're getting more cash back. But if you're a lender to the company, what happens when a company increases dividends? But forget about the stock price. As a lender, why do you care about bigger dividends? How does it affect you directly? That cash, instead of being in the company, leaves the company. It no longer backs your loan. A higher dividend can never be good news if you're a banker or a lender to a company, because holding all else constant, you prefer company. That's why bankers should not be allowed to run companies for their equity investors, because here's what I'll safely predict you will do. You will pay no dividends and accumulate the cash saying, I need it for my loans. You probably won't borrow any extra debt because you want to make it as secure as you can. But you can see why when you look at lending covenants, there are often restrictions on dividends, because those are the restrictions put in there to prevent you from doing this. So when we talk about taking advantage of lenders, it's because they've left themselves exposed by not protecting themselves. In those cases, you'd see big dividends paid to take advantage of that. So let's bring this all together. I showed you a survey when we talked about financing and what CFOs think. So this actually looked at, hey, how do you decide how much to pay in dividends, and ask CFOs questions about what drove dividend pay. So I'm going to go from what they claimed was the most critical reason driving payout ratio to what they claimed was. So I'll read the statements and I'll list out what percentage of CFOs agreed with each statement and what percentage disagreed. So here's the first statement they were read. A firm's dividend payout ratio affects the price of the stock. 61% said, that's of course true. 33% said no. 6% disagreed. 33% said, I have no idea. That's kind of scary that the middle column is actually much, much bigger than the disagree column. The second statement that was read is dividend payments provide a signal of the future. 52% said yes, 41% had no opinion, 7% disagreed. The market uses dividend announcements as information for assessing firm value. 43% agreed, 51% had no opinion, 6% disagreed. Investors have different perceptions of the risk of dividends. That's the bird in the hand fallacy. 56% say yes, that's true. 2% disagreed, 42% had no opinion. Investors are indifferent between dividends and capital gains. Why would they read that statement? Because that's the central theme in the Miller Modigliani theorem, right? 6% agreed. That 64% disagreed. Stockholders are attracted to firms that have dividend policies based on what their circumstance. That's a clientele story. 44% agreed, 7% disagreed, 49% had no opinion. And the final statement they were in is management should be responsive to shareholder preferences. 41% agreed, 10% disagreed, 49% had no opinion. I mean, that lists out all the things we've kind of talked about. So basically what I get out of this is all of those things go into that bucket where companies decide how much to pay. So let's start on that last segment of dividend policy, because in a sense, at the end of this, you're saying, well, how do I decide whether my company is paying out too much, too little, or just the right amount? So I'm going to take you through two ways that I use to assess how much a company should pay in dividends. So basically, we're going to focus on this very last box. How do you decide how much to return and in what form, dividends or buybacks? So let's get started on that last question. There are three questions I'm going to ask when I look at a company to decide whether I'm okay with how much cash it's returning. The first question, and basically this is what I call the cash trust nexus, and it goes back to the point earlier of dividend policy more than any other aspect of corporate finance is built on trust. If you trust managers in a company, you're going to give them a lot more freedom in setting dividend policy than if you don't trust them. I'll also give you the second way in which many companies set dividends, which is they look at everybody else and they say, me too. That's how they did capital structure. So let's start with that cash trust nexus, and there are three questions I'm going to ask about every company. The first question I'm going to ask should be the easiest one. I'm going to look at what my company has actually returned to its shareholders, and I'm going to focus on both dividends and buybacks because I want to be realistic. If the way you're returning cash is buybacks, I want to be clear about how much you're returning. The second question I'm going to ask, and this is really the question that I think is going to make or break this analysis, is I'm going to ask how much cash could they have returned? Do you see the contrast? The first question I'm looking at what you actually did return. The second question I'm going to ask how much could you have returned? It sounds really difficult, but it's actually very easy to answer. And I'm going to present evidence that 80% of companies pay out less than they can. They return less cash than they can afford to. Which tells you what cash is accumulating in the company. So the third question I'm going to ask is, how much do I trust the managers in this company with my cash? And I want to be clear, this is my cash. It's not the company's cash. It's not the manager's cash. It's my cash. How much do I trust them? And to answer that question, I'm not just going to ask managers, can I trust you? Because that's a stupid question. I'm going to look at their own history. Have they taken good projects? Have they delivered good returns? If they've done well for me, I'm going to be more likely to trust them than if I don't. Okay? So let's start with that question of how much cash have my companies returned. So again, I'm going to take my 5 companies. I'm going to look at how much they've returned in dividends and how much in buyback. So let's take Disney. Between 2008 and 2012, Disney paid $4.5 billion in dividends collectively over the 5 years. They returned about $15.4 billion in buybacks. So if you look at the entire period, they returned almost $20 billion, but more than 75% took the form of buybacks. If you look at Vale, their dividends of almost this is billions of US dollars, almost $24 billion in dividends. And they bought back about $5.7 billion. So even Vale is starting to buy back stock, but only about 20% of the cash they return takes the form of buybacks, 80% is dividends. Tata Motors paid almost all of their cash in the form of dividends. Buybacks are still uncommon among Indian companies. Almost all of it takes the form of dividends. Baidu, of course, was easy. No dividends, no buybacks, no cash returned at all. And Deutsche returned almost all of their cash in the form of dividends. So basically, even across the 5 companies, you can see Disney is furthest down the road of shifting to a buyback-based policy. And Deutsche is least down the road because they do almost no buybacks. So here's basically the way I'm going to assess these companies. I'm going to look at how much cash they could have returned. You're familiar with the 3 accounting statements, right? There's the income statement which tells you how much your company made last year. There's a balance sheet that tells you what the accountant feels they own or owe. And then there's a statement of cash flows. When you assess dividends, the accounting statement you should be almost always stuck on is the statement of cash flows, because that's where all the information I need to make this assessment is going to come. So here's what I'm going to do. I'm going to think like the owner of a business. And here's what I'm going to try to compute. I'm going to look at how much cash is left in the till at the end of the year after I've met every conceivable need. You ready? Let's go on a journey. You're the equity investor in a company. You're the owner of the equity, the entire equity. You start with net income. Why? Because that's the accountant's measure of what income you have as an equity investor. So you start with that. Then you remember that's accounting earnings. It's not cash flow. So you add back depreciation and amortization. So if you're familiar with statement of cash flows, you'll actually track what I'm doing. I'm starting with net income, adding back depreciation, amortization, and other non-cash charges. That tells me how much cash I get from operations. Now I get ready to write some checks. First, if I have any capital expenditures, that's cash leaving the business, I take it out of the till. Second, if I have any working capital needs, if my inventory has to go up, my accounts receivable go up, that's more cash leaving the till, so I take that out of the kit. If I have any preferred equity I've issued, that's like a dividend that I have to pay, I write that check out. So I write out every conceivable check I have to. And then at the end of the process, I look to see what's left in the till. I call that my free cash flowed equity, but don't get thrown off by the buzzwords. It's free because it's after I've met every conceivable need. It's a cash flow because I've added back depreciation and amortization. It's to equity because I'm thinking like an equity investor. That is my potential dividend. Free cash flowed equity is my potential dividend. You take any company statement of cash flows, you should be able to compute the free cash flowed equity in the most recent year. So let me ask you a question. Can that number be negative, the free cash flowed equity? Can it be negative for a company making money, for a company with positive net income? Absolutely, right? You can have positive net income and huge negative free cash flowed equity. We have huge capital expenditures relative to depreciation or huge working capital needs. And if you have to repay debt, that becomes a cash outflow. And here's the plus. If you borrow money, cash comes into the company. So all of those debt cash flows considered, you can have negative free cash flowed equity. So let's make dividend policy really simple. Let's say you compute this for your company. And you get negative free cash flowed equity, not just 1 year, but year after year. How much should your company be paying in dividends? Don't think too long. If you have negative free cash flow equity, you're already in a hole. Stop digging. You're going to be surprised how many of you that's going to be the end of your dividend analysis. You're going to look at year after year, you're going to see negative free cash flow equity. But in that statement of cash flows, you'll also see dividends and buybacks listed, right? And in a segment of these companies, in a not a small segment, you see negative free cash flow equity accompanied by buybacks or dividends. And you're going to say, what the heck are you guys doing? I don't need to dig too much more to know that this is not sustainable. But that's a very simple comparison you can start. So let's assume that your company's free cash flow equity is positive. So that's your potential dividend. Then you could look at your dividends and buybacks to see if that number is close to your free cash flow equity. And I've already given away the game. I said for 80% of companies, what you see paid out will be less than what they could have paid out. And we know this is going to happen because companies have cash balances. That's how you accumulate cash balances. So if you can, before Wednesday's class is not realistic. You have a quiz coming. After Wednesday's class, sometime before May 8th, which you have to anyway, compute the free cash flow equity for your company using the statement of cash flows. It's a good starting point for thinking about how much could my company have paid out in the most recent year.
So I've been talking to these guys about the media company or return value. Their projected sort of cash flows are just for the couple of deals they have. They don't have name recognition. They don't hold any IP. So do you think the value of the company for someone who wanted to partially buy in would just be the percentage of those?
Exactly. That's it. Thanks.
Why do we compare the equity risk premium
That's
versus
if you're issuing
doubling?
equity, you could pick any other default spread. You could pick any default spread. This is just to capture the changes over time. You could have picked single A, double A. You get the same kind of graph. Same kind of graph.
Okay.
What you're trying to capture is the price of risk. So I picked one rating and stayed with that rating because then you can see what the price of risk is in the bottom line.
We unlevered the firm value, right?
So basically our existing firm has debt, right?
Right,
Now I'm saying what would happen if I did not have that debt?
right.
If I don't have the debt, the tax benefit from the debt goes away, right? So
Yeah.
I subtract it out.
Right.
And if I don't have that debt, I shouldn't have that expected bankruptcy.
Right,
Right?
that's
So basically I add it back up.
What if we think about it from the debt and equity ratio standpoint? Like, why? I guess this way is easier to.
Yeah, it's much easier, right? You could think in terms of cost of capital and working it through. This is just much simpler because you know what the dollar debt is, you know what the tax benefit is. You might as well just get directly to the unlevered
So
firm. And
it's like equivalent.
it's equivalent and it's probably easier.
Okay. Thanks.
Okay. Hi, how are you?
We won't have a review session for quiz.
I announced at the start, I'm going to try to do it at 12 tomorrow, but I have a 9:30 appointment in New Jersey tomorrow. And by the time it's done, I'm not sure I'll make it by noon. So I'll let you know. If I don't make it, I'll actually put up the review session from last semester, which is pretty similar to this semester's. But I'll send out the review slides today.
Okay.
And I'll give you both the regularly scheduled session and if that doesn't happen, by 11 o'clock tomorrow. So 12 to 1 was the scheduled review session in 260. So if I can pull it off, I'm going to try to pull it off. If I cannot pull it off, the backup is going to be the recorded review session for last.
Thank you.
Okay. Hi, how are you?
Good.
Good.
I just had a quick question
Yeah.
because I was trying to think through the optimal debt ratio for that company and calculating that. So the results of doing the spreadsheet were a little bit surprising in that the company's optimal debt ratio is about 6 or 7% beneath what it was at its current rate.
Right.
So reducing the debt ratio reduced the cost of equity because of the debt to equity
But the
ratio.
cost of
It reduced
capital
the
went up.
cost of,
You're
debt
probably
as
at,
well.
but remember, if you're within 6%, you're probably at close enough to your optimal that you basically, that if you were 20% off, I could have told you what to do next because what's happening is because I'm using synthetic ratings.
if your actual rating is much higher than your synthetic rating, you can get this phenomena of, hey, my optimal is 40, I'm at 62, but when I go to 40, my cost of capital is actually higher than it is at the 62%, which is where I am now. The way to fix that is the very last box in the input page says, do you want me to adjust? So basically, do you want me to use so in which case I will then recompute your cost of capital using a synthetic rating so that everything, because right now here's the incompatibility. My cost of capital for my entire 0 to 90% are based on synthetic ratings because I have no choice.
Yeah.
Your current cost of capital could be based on your actual rating, right?
Right.
So because and so if my synthetic ratings are all consistently lower than your actual rating as I go through, you're going to end up with this phenomenon. I hate the optimal is my cost of capital actually goes up. And I'd view that as one of two things. One is the ratings agencies do screw up sometimes. So maybe the synthetic rating is a much better way of thinking about your long-term risk. The other is, let's face it, the synthetic rating is based on one ratio, the interest coverage ratio. It's